My name is Lisa Rispoli. I head up the Trusts and Estates Division of Grassi and Company. My team and I, including Marianne Shugman in our Park Ridge office, we assist trustees with the administration of trusts, executors with the administration of estates, and litigation support for attorneys. So there's good news and bad news in the estate tax world. The bad news is that the estate tax has not been repealed. The good news is that for a limited time, it applies to a small number of people, only a small number of people. The basics of estates and gift tax. So estate and gift tax is a tax on the transfer of wealth for U.S. citizens and residents on all of their worldwide assets. It is a cumulative tax on lifetime transfers. So if during your lifetime you give away $1 million and you die with assets of $5 million, your taxable estate is $6 million, the 5 and the 1. The $1 million gift, the value of that gift is frozen when you make that gift. That's the benefit for making it. If you died prior to 2018, the tax on that estate would have been about $220,000. In addition to the estate and gift tax, there's a generation skipping tax. So if you attempt to skip a generation and give assets to your grandchildren or someone who is 37 and a half years younger than you and not related to you, you'll pay a GST tax, generation skipping. The new law provides an exclusion from estate and gift tax that has been temporarily modified. In 2017, the exemption was $5,490,000. Under the new Tax Reform Act, it is estimated to be $11,180,000 through December 31st, 2025. If you exceed these exemptions during lifetime, you'll pay a gift tax at the same rate as estate tax. And lastly, there are annual exclusions of $15,000 per person per year. This went up in 2018. It used to be $14,000. So you can gift up to $15,000 per person and not file a gift tax return, assuming you're not taking any valuation discounts. Gifts can be split, so between a husband and wife, they can give one person $30,000. So as I said, the exemption is increased to $11,180,000. The law did not change the step-up in basis, so if someone dies and you inherit an asset, the fair market value at their date of death is your new cost basis for income tax purposes. There was a change in the calculation of the cost of living adjustment. That's why we're not sure if it's $11,180,000. Some people say $11,200,000. It's not set in stone yet. But after 2025, it reverts back to prior law. Again, we don't know what that's going to be because of the cost of living adjustment change, but we're guessing $5,600,000. So what happens if you are lucky enough not to die before 2026? It will possibly go back to $5,600,000. But will there be a clawback? Let's look at history. In 2001, the Tax Reform Act, signed by George W. Bush, raised the exemption with a similar sunset. It was $675,000 in 2001, and it went up to $3,500,000 in 2009. The estate tax only was temporarily repealed in 2010, and then it was supposed to go back to $1 million in 2011. 2010 Tax Act came out, which was a temporary fix, and it gave us a $5 million exemption effective January 1st, 2010. But that was supposed to end at the end of 2012. There was still fear that the exemption was going back to $1 million. Finally, on January 2nd, 2013, President Obama, on a Democratic regime, signed into law the American Tax Relief Act of 2012, making that $5 million permanent. And it was permanent for estate, gift, GST tax. There was an increase provided for inflation and a 40% top tax rate. So based on this, it doesn't seem likely that they will revert back based upon history, right? But even if they did claw it back, the way the tax is calculated makes it very unlikely that if you make that increased gift and take advantage of those exemptions, that it will hurt you. This example shows us that if someone makes a gift of $12 million, when the exemption is $11,180,000, they'll pay tax of $328,000. If they died with assets of $30 million, those gifts get added back. Their taxable estate is $42 million. Now I can't see it from here, but the tax paid, the estate tax, I think is about $16 million, but they get a credit for the gift tax as if they paid under the current law when the exemption went back to $5 million. So this assumes the exemption went back to $5 million. The credit for gift taxes paid would be $2,000,008, even though they only paid $328,000. So all of this tells us it is a good time to do some gifting, to take advantage of this increase in exemption. If we use the old federal exemption in 2017 of $5,490,000, we would have an additional $5,690,000 to gift for federal purposes. But these are federal amounts. New York, much lower. The New York exemption right now is only $5,250,000, and if your estate exceeds 105% of that amount, your exemption is zero. So on January 1st, 2019, it will match the federal exemption under the prior law, which we're expected to be $5,600,000 on January 1st. This large disparity in the exemption could create an estate tax due in New York. New York pulls back gifts made within 3 years of death, but only if you die before January 1st, 2019. So if you die before January 1st, you take advantage of this new exemption, you will have a large estate tax in New York, about $1,255,000 if you gifted $11 million all within 3 years. So it's best to wait till 19 to take advantage of these exemptions if you're a New York resident. The next slide is the Connecticut exemption. Connecticut's exemption in 2018 is $2,600,000. But if you are a Connecticut resident, there is a gift tax. So if you take advantage of the federal increased gifting, you will pay a gift tax to Connecticut. Under Connecticut law, the exemption is going up and is scheduled to match the federal exemption, but more than likely, the Connecticut lawmakers will get back to the table to change the law. They're not going to want an $11 million exemption. New Jersey's estate tax is repealed effective January 1st, 2018, but there's still an inheritance tax to certain beneficiaries, and the top rate is 16%. It doesn't apply to surviving spouses and lineal descendants. The new deduction for qualified business income does apply to trusts, a 20% deduction. So if a trust has an interest in a business, they will get that deduction. The miscellaneous itemized deductions, the elimination of the miscellaneous deductions also applies to trusts and estates. The next slide showed us where not to die. There were many states that were grayed out. There's not many states with estate tax or inheritance tax. There are two states, that Maryland and DC, which is really not a state, that has an estate and an inheritance tax. There's two planning methods I wanted to mention. One is the intentionally defective grantor trust. So a grantor transfers assets into an intentionally defective grantor trust, typically a business interest. The value of the interests are discounted for lack of marketability and minority interest. For estate tax purposes, this is a completed gift. And my slide would have showed you that the transfer of the business interest would go into the trust, but it's not, it doesn't qualify for income tax purposes. So it's a completed gift for estate tax purposes, but for income tax purposes, it's not recognized. So it's a great tool where a grantor transfers the assets to the trust. The grantor continues to pay the income tax on behalf of the beneficiaries. That payment of the income tax is a tax-free gift by the grantor. But what if the grantor still needs cash flow? This business interest goes into the trust, they can't touch it anymore, it's not their asset, they've gifted it out of their estate, but they still need some cash flow. So rather than gifting it, a common tool will be they'll sell it to the trust because it's not recognized for income tax purposes, and they'll take back a promissory note. The trust will make payments on that promissory note, interest payments, possibly principal payments, or the grantor can gift the balance, but it's a way to transfer assets, take back a cash flow, and we've frozen the value of that business interest. A grantor retained annuity trust, which is a GRAT, is also a common tool that is used. Same idea, business interest. Doesn't have to be business interest. Any assets go into the trust. The grantor takes back an income stream, an annuity payment. The gift is discounted even more, but the risk is that the asset could get pulled back into the estate if the grantor dies before the end of the trust term. Many times we will have those GRATs zeroed out, which means the value of the gift is zero. But it's very important that the assets grow faster than the IRS rate, which currently is 2.6%. Otherwise, doing a GRAT is useless. Okay, so the Tax Reform Act has provided an opportunity for those with significant wealth to make an additional gift. According to the IRS statistics, though, 8,000 returns were filed in 2016 with gross estates less than 10 million. 4,000 returns for estates more than 10 million. It's only 4,000 estates for more than 10 million. It's not a big number. We should look very closely at our existing wills for funding of trust at death under these new rules. Income tax planning has become much more important than estate tax planning. Basis at death is very important. So if we have existing trusts where the wealth is less than 11 million or 22 million if we're married, it may be a good idea to look at those trusts, especially if the client is elderly and we think they'll die before 2026. We may want to decant those trusts to get those assets back into the estate so we can get a step up in basis. Thank you.